What's going on YouTube, TikTok, or social media? Let's get into this video and talk about the dividend snowball. Now, if you don't know what a dividend snowball, it's just your compound interest and reinvestment of your drip or dividend reinvestment is going to compound your portfolio.
The dividend snowball effect refers to the compounding growth of dividend income over time. When an investor reinvests dividends into buying more shares, those additional shares generate even more dividends. Over time, this cycle accelerates, leading to exponential growth in passive income. This effect is amplified when combined with consistent investments and dividend increases from companies.
Now, I'm going to show you 3 strategies today to how to build a snowball dividend portfolio. Now, I'm going to pick a well-known stock so everyone can see, and that stock is going to be Fidelity High Dividend ETF, or FDVV. Now, that's the one I'm going to use for the example, and at the end of the video, I'll show you a few more. Pick and choose which one you want to choose, an ETF, index fund, or mutual fund, and not do individual stock when you do this, but I can't stop you.
ETFs or stocks, which one's right for you? Let's break it down. Stocks, you own a piece of one company. That means all your risk and reward depend on that single company. Great when they're up, not so fun when they're down. ETFs, on the other hand, are like a basket of stocks. You own a little piece of many companies, giving you instant diversification. Less risk, yep, but potentially slower growth compared to individual stocks.
It's just for everyone who's watching this video. If you're a beginner, I recommend to allow someone else to do the management and you just invest one time, monthly, or even daily. So let's get into this video and talk about the 3 different strategies you can do. You can do a lump sum strategy where you can put $20,000 at one time and just allow it grow, sit it and forget it. And I'm going to show you an example of that shortly. And then the second strategy is you do a monthly contribution. And that is where we're going to show you $200 a month and how that compounds in the future. Now, and the third one is going to be daily $20 to invest. Now, each one of these strategies is unique and it is up to you which one you will prefer. Now, I prefer to do the monthly because that's easier for me to afford and easier for me to do. But some people have 20, 30, 40,000. They might have come into inheritance, whatever it is. They might have some money, want to do something with it, and they found out about the dividend snowball. And then lastly, maybe you do every day you transfer $20 into a dividend account and constantly invest it and sit it and forget it. So let's talk about this dividend investment and why I think dividend investment is so good for you compared to investing in normal stocks.
Dividend stocks are boring, which is exactly why you want to own them. Look, let's face it, dividend stocks don't get the headlines, they're not moonshots, they're not meme-worthy, and they're not promising to be 10 times by Friday. But here's the truth. Dividend-paying stocks are the quiet engines of wealth. While everyone's chasing the next hot tech name or a hyped-up AI play, dividend investors are getting paid quarter after quarter, regardless of whether the market's flying or falling. That's real cash hitting your account without having to sell a single share. Try getting that from your growth stock du jour.
And Mr. Wonderful says it perfectly in this video.
Never buy a stock that doesn't pay a dividend. That has been your advice through and through. Why are these stocks more attractive?
You look at companies that don't pay distributions, don't return capital, how risky they are. Take a GoPro, for example. I'm not just picking one company, I'm just giving you a good example of a company that basically has lost 70% of its value, never returned a dime to shareholders. Or how about a company that's been around much longer, Yahoo? Never paid a dividend. It's never made money for anybody except all the CEOs that have gone through there and got whacked.
Now that we found out why I prefer using dividend stock, now it's not the end of the world if you don't like dividends, but I'm going to talk about the Fidelity High Dividend ETF, FDVV. So Fidelity High Dividend ETF, it's just a fund that seeks to provide investment returns that correspond performance of the index funds. So Fidelity High Index Fund, it has a dividend payout of a 2.94% or $1.96, and it's worth $56. Now, we're going to use the yearly return, but it has a really good growth return over the max of 119%. The 5 years is 107%, so it has a pretty good return. It's a decent stock, and a lot of people know about it. Now, I'm picking this stock primarily because I've used Fidelity, but I'll show you some more at the end of the video. Maybe you don't have Fidelity and they're going to charge you to purchase this, but let's get into the history of this dividend. So, according to Stock Analyst, it says that the dividend yield is 3.08%, and we're going to use this number to do our analysis, and the annual is 1.72 with quarterly payout. Very big note, it pays out quarterly, so you understand. And the payout ratio is 61.22% with a dividend growth history of 22.04%. Now, that dividend growth, I don't think it's going to be sustainable, so we're going to cap it out at 8%, just so that we can have a good number, because the growth of 22% every year doesn't sound reasonable, but let's cap it out 8%. That's a very high dividend payout. I don't think it'll get that far, but it just makes the number easier. So let's go into our dividend calculator and plug in the numbers. So we're going to put time horizon 30 years because I want to build this portfolio for 30 years so that we can see the results. Now we're going to do 30 years, and initial investment is going to be $20,000. With 11% year over year. And the reason why we're doing 11%, because it gave us 11% return last year, and it seems to be consistently giving 11%. It's just an assumption. It might not really do this. So let's check out what the number is. So the ending balance after all that time, make sure we get the numbers correct, 20,000, and the max at 5% right now, we have $1.5 million at the ending balance with the cumulative dividend of $422,000 paid out to you, and you're getting $508 or $58,000 annually to pay you, that you don't have to touch your nest egg, and the ending dividend yield at 5%. So let's change the number. I think let's change it to 8%, and I'll show this one on the screen so you can see it. So at the end, if we change it to 8%, which is could happen, but I'm giving you an example of how drastically it will change. $2.7 million, and they paid out $1 million in dividend, and now you have a yearly income of $160,000 a year for a one-time contribution of $20,000. That's crazy, right? So who should do this strategy? Well, if you have $20,000 laying around, some people do have this just sitting around, and you just want to set it and forget it, it's a great strategy for you to do. But let's do something more realistic. You have $0 to invest. We're going to change the max back to 5% a year. Max yield, that means that's the max it'll give you a year. And $200 a month. Now, the number here is $3 million at the end of it. And it's going to be paying you $111,000 a year for your portfolio. So you don't even have to buy anything else, just this one ETF, and you can retire without touching your nest egg.
Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor then? No, not at all. I knew it was going to be worth more over time. American business is going to be worth more over time. That's what you're buying as a business. You're not buying a stock. You're buying a piece of a whole bunch of businesses.
Sounds pretty good. So who should do this? This one's easier to compete. It's just $200 a month.
So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because the very nature of index funds is that you are saying, I think America's business is going to do well over, or reasonably well over, a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
In this ETF. Now, this isn't an advertisement for you to buy this one ETF, but it is a possibility, and this is why I like dividend so much, because at the end of 30 years, it pays you well. Now, let's change it to 8% since I showed you what 8% look like at $20,000. And at the end of it, you're going to have $4.5 million with a dividend income of $258,000 a year. At ending dividend yield. Now, we can look at the numbers and see how long down here before it takes for you to get $50,000, $60,000 a year to get paid out. Let me see. One do $40,000 or $57,000. It'll take you roughly 21 years, and you'll get $46,000 or $57,000 in dividend paying a year if you don't want to work anymore. So if you're at the age of 40 and you got 20 years before retirement, it's a possibility you do this and you still can get $57,000 or $46,000 a year. Now, here's the next one we're going to do. It's $20 a month. And I'm going to show you on the screen the math that it takes so that you understand how it works. So we need to do $20 by 365. It'll give us 7,300. And I'll put it on the screen. And then we're going to have to divide it by 12 so that we understand what the payment is going to be a month. And that payment is $608. So let's change our number to $608 with 11% growth a year with a 5% dividend yield. And it will give us $9 million after 30 years, or $9.4 million with a dividend income of $338,000 a year. And people said, oh, dividend investment is not worth it. Well, here's some numbers. Some people will get the 11% return without the dividend. And if you don't get the dividend yield, it's fine. It's however you want to invest. This is just the strategy I use for one of my portfolio. Now let's change it to 8%, and I'll make sure it's on the screen so that you can see it. So 8%, it gives you a whopping $786,000 in dividend income a year. And now in this video, I did put a tax rate of a dividend of 15%. So if the number looks a little bit off, I added taxes in there just so we can have a more realistic idea. So let's go into other dividend stocks that you can use. Maybe Another good one that I see a lot of people get is SPYD. And now it pays a 4.06% in dividend yield. And it's worth $42. And I'll put it on the screen so you can see it. And this is another good dividend. And the last one, Vanguard High Yield Dividend. It's another dividend paying stock. It looks pretty good. And it pays a 2.5% dividend yield. You don't have to just pick one of them. You can mix it up between all three of them. But those are the 3 dividend stocks I recommend. It pays good and they have good returns. Now, should you use this style of investing? Well, that's up to you. I wouldn't recommend putting this in your retirement. I would recommend you doing this in a separate account if set away. Doing this in a brokerage account, not a Roth, and not a 401k plan, because this is a risky style investment. With all risk, it comes with high risk comes with high reward. So you need to understand that this isn't a traditional style of investment. And you can invest this style, but it's at your own risk. And that's how I would build up my Snowball, with those 3 stocks and 3 different method styles of investment. And just so you know, make sure you automate it. It makes it easier. Like and subscribe to my video, and that's all I got for you.